You know, when people say that money is cheap, they don't mean that money is cheap for everyone. They mean that certain people can borrow for 30 years at 3%, while everyone else borrows short-term at double-digit rates. That difference isn't about hard work or intelligence. No, it's about who the system is willing to lend to cheaply. Cheap money means mortgages, corporate loans, asset-backed credit. Expensive money means credit cards, personal loans, and consumer debt. In this video, we're going to break down who actually gets access to cheap money, who doesn't, and why that single difference explains why some people keep winning even when they mess up. Welcome to Alex. All right, so what does cheap money really mean? When people talk about cheap money, they usually misunderstand what that phrase is. They assume it means borrowing is easy and that money is cheaper for everyone. But that's not how the system works. Cheap money is not about money in general. No, it's about a specific category of loans with very specific rules, and most people never touch it. Cheap money has 3 defining features. Okay, first of all, low interest. We're not talking about slightly lower rates here. We're talking about borrowing costs that sit close to inflation, sometimes even below it. Rates where the goal isn't speed, but stability. Secondly, long duration. So, cheap money is stretched across decades, 20 years, 30 years, sometimes longer than that. And that time element matters more than most people realize because it turns pressure into patience. Third, and this one is key, collateral. Cheap money is almost always backed by assets a lender can control if things go wrong. Property, businesses, securities, cash flow producing assets. If a loan doesn't have all 3, it is not cheap money. It might look affordable at first, but it behaves very differently under stress. So, let's make this real, okay? Cheap money looks like a 30-year mortgage on a house. It looks like a corporate loan backed by buildings, revenue, and contracts. It looks like a margin loan backed by stocks. It looks like asset-backed credit used by institutions. And these loans share something important, flexibility. They can be refinanced. They can be rolled forward. They can survive bad timing. But compare that to expensive money. Expensive money looks like credit cards, personal loans, payday loans, short-term consumer debt. Interest is high, timelines are short, and the rules are strict. Miss a payment and penalties hit immediately. There's no refinancing safety net, no patience built into the structure. What confuses people is that both types of money exist at the same time, often offered by the same banks, same currency, same financial system, completely different behavior. When central banks lower rates and the news says that money is cheap, they are talking about the cost of money inside that cheap money system. They are not talking about cheaper credit cards. They are not talking about easier personal loans. They are talking about long-term asset-backed borrowing becoming cheaper for borrowers who already qualify. For everybody else, money often stays expensive or becomes more expensive. This is a distinction that most people miss. Cheap money is not something you stumble into. It's not a temporary condition. It's a category of financing reserved for certain types of borrowers. And until you separate cheap money from consumer credit, it's impossible to understand why some people can borrow through crisis, buy asset during downturns, and survive mistakes that typically would wipe others out. This video only works once that line is clear. Because from here on, the question isn't whether cheap money exists. It's who actually gets access to it and why. And before we dive into that, just a heads up that you get access to knowledge like this, but even more diverse and in-depth within the Alex app. Think about it, okay? If we give you this quality here for free on YouTube, just imagine the value we can offer you behind the paywall wall. The Alex app boasts the largest community of high net worth individuals. And aside from the daily coaching sessions and expert collections teaching you insider knowledge to level up, you also have access to the Alex Network, a brand new feature where you can chat with other vetted professionals about things like the best accountants to use, what investments are looking promising, giving and receiving feedback and advice on projects that you're working on. Being an entrepreneur can be pretty lonely, but it doesn't have to be. All the best. Know that success doesn't happen in a vacuum. It happens with help. And if you go to Alex, call our app to download and then scan this QR code on screen, you can join us inside for 25% off your annual subscription. And with that said, let's get back to business, shall we? All right, so who actually gets access to cheap money actually gets access to this cheap money? Because now that we're clear on what cheap money is, that's the next obvious question. Who gets it? And the answer isn't complicated, but it is uncomfortable. Cheap money goes to borrowers the system considers safe, recoverable, and non-threatening. And that creates a very clear order. At the top are governments, right? Governments borrow at the lowest rates in the entire system, often for decades at a time. And they can do that because they control taxation, currency, and law. If something goes wrong, they don't default the way that an individual does. They restructure, inflate, or change the rules. And that makes government debt the benchmark for cheap. Next are banks and large corporations. So big institutions borrow cheaply because their risk is spread out. They've got diversified income, regulated balance sheets, and political importance. When they fail, the system steps in to protect itself. In other words, if a large bank or huge corporation is in danger, the government will intervene to save it in order to avoid widespread damage. This is why large corporations can issue long-term debt at low rates while small businesses simply can't. It's not about effort, it's about systemic impact. Then come asset owners, people and entities that own property, businesses, or large portfolios. They qualify for mortgages, asset-backed loans, and margin credit. The key here is collateral. Assets give lenders something they can measure, insure, and sell if needed. That makes the loan recoverable, which lowers its cost. This is why someone with moderate income but a house often gets cheaper money than someone owning more but owning nothing. Now, below asset owners are high-income, stable professionals, doctors, executives, partners, senior specialists. Not because income is magical, but because stability matters. Long employment history, predictable cash flow, and low volatility reduce perceived risk. Even without major assets, this group can sometimes access long-term low OC cost credit. And then there's everybody else. People with volatile income, little to no collateral, short time horizons. This group does not get cheap money. They get credit cards, personal loans, and short-term consumer debt. The system isn't asking who deserves cheap money. It's asking who can borrow, without threatening stability. And once you see that, the pattern becomes obvious. Cheap money flows upward toward entities that can absorb shocks and survive mistakes. Expensive money flows downward toward individuals who can't. And that's why the phrase money is cheap is so misleading. Money is cheap for borrowers who already qualify for cheap money. For everybody else, it never was cheap and it never will be. And this hierarchy is what shapes financial outcomes long before personal decisions ever come into play. Now, you might be wondering why. Why does the system work this way? Why does the system work like this? Why do some borrowers get low rates, long timelines, and flexibility while others get strict rules and high costs? Well, the short answer is because it's the only way it can work. The more complicated answer is because of risk control. Banks and lenders don't think in terms of potential. They think in terms of what happens if this goes wrong. Every loan starts with the same question. If this borrower fails, how much damage does it cause and how much can we recover? That single question explains almost everything. This is why collateral matters more than character. An asset can be valued. It can be insured. It can be sold if needed. And it exists independently of the borrower. A person doesn't. People lose jobs. They get sick. They move. They make bad decisions. From a lender's point of view, none of that is moral failure. It is uncertainty. Assets reduce that uncertainty. That's why a mortgage is cheaper than a personal loan. Not because buying a house is virtuous or anything, but because the house could be taken and sold if those payments stop. And the same logic applies to institutions. Large banks and corporations borrow cheaply because their failure doesn't stay contained. If a major bank collapses, payments freeze, credit dries up, and other institutions are pulled down with it. Governments step in not to save shareholders, but to stop the damage from spreading. And lenders know this. Okay, so when they lend to system-important institutions, they price in the expectation that emergency funding will appear, mergers will be forced, and losses will be absorbed over time instead of happening all at once. That expectation lowers perceived risk, and lower risk means lower interest rates. Now, this does not apply to individuals. If an individual defaults, the damage is limited. There's no need for emergency intervention, no system to protect. So the loan is priced as fully exposed risk. And stability matters for the same reason. A borrower with predictable income is easier to model. Payments are easier to forecast. Defaults are easier to manage. That's why long employment history and steady cash flow lower borrowing costs even if total income isn't extraordinary. Volatility. Well, that does the opposite. Variable income, short history, or dependence on a single source increases uncertainty, and uncertainty raises risk, and risk raises interest. This is why the system seems to reward stability more than ambition. To put it simply, the system lends cheaply to borrowers it can control. It charges more when control is weak, and it penalizes borrowers where failure is hard to manage. So why is cheap money so valuable? And what access to cheap money allows you to do? The answer to that is to have options. The first major difference is how debt gets handled. People with cheap money don't rush to pay debt off. They roll it forward, meaning they replace it with a new debt on similar or better terms, extending it in time. A mortgage isn't something to try to eliminate quickly. It's something they refinance when rates change, extend when cash is tight, restructure when conditions shift. If timing is bad, they wait. If market's full, they don't panic sell. They are allowed to sit through volatility because their financing doesn't force immediate decisions. People without cheap money, they don't get that choice. Short-term high-interest debt creates urgency. Payments arrive fast. Interest compounds quickly. Mistakes have immediate consequences. Instead of asking, is this a good long-term decision? They are forced to ask, can I survive this month? The second difference is how risk works. Access to cheap money allows people to take calculated risks. They can buy assets and hold them through downturns. They can invest knowing that returns don't need to show up immediately. They can survive being early, which is often the same as being right. Without cheap money, risks look very different. A bad year isn't a setback, it's an exit, sometimes a forced one. Selling early isn't a strategy, it is a necessity. Avoiding risk entirely becomes rational, even when upsides exist. So, one group compounds experience, the other keeps resetting. Now, the third difference is how people interact with inflation. With long-term low-cost debt, inflation works quietly in the borrower's favor. Prices rise, assets become more valuable, but the loan stays fixed. Over time, the real weight of that debt shrinks. With short-term high-cost debt, inflation does the opposite. Living costs rise immediately. Interest adjusts upward. Debt becomes heavier instead of lighter. The same economy but completely different outcomes. Now, the final difference is failure. In the cheap money system, failure is usually only partial. Losses are spread out. Capital survives. A bad deal becomes a lesson. A downturn becomes a delay. In the expensive money system, failure is often final. Penalties arrive quickly. Capital disappears before lessons can turn into experience. And this is why success seems to repeat in the same places over time. This creates a loop. Access to cheap money creates flexibility. Flexibility creates better positioning. Better positioning makes lenders even more comfortable extending cheap money. Meanwhile, people without access are pushed towards safety, speed, and short-term decisions. And the uncomfortable reality is that most people will never get access. People will never get access. Cheap money requires assets that can be valued, insured, and sold. Things like property, businesses, financial portfolios, and so on. But the problem is these assets are very difficult to acquire without cheap money. It is a circular gate. Without assets, you don't qualify for cheap money. Without cheap money, building assets is slower and riskier. At the same time, cheap money assumes long timelines. Most people simply cannot operate on decadal-long decisions. Rent is due monthly. Bills are immediate, and emergencies do not wait. Short timelines force short-term decisions. You can do everything right and still get denied because the only way to get access to this system is to become an owner, not a consumer. The system doesn't ask, is this person trying? No, the system asks, can we recover it if this goes wrong? And for most people, the honest answer remains a no. This is why access to cheap money clusters. Why the same people keep getting that flexibility and while others feel like they are permanently playing on hard mode. We hope you learned something here today. Alexa, thanks for spending some time with us. We'll see you back here next time. Until then, take care.